Entrepreneurs come in many shapes and forms, and their ideas can act as drivers of economic growth for countries and industries. Their companies and creations can soar to fantastical valuations, becoming embedded in the everyday lives of billions and creating fabulous wealth for their founders. But equally, they can never make it off of the drawing board or can disappear without a trace. For those bright sparks whose ideas really catch fire, building and running a company of their own creation can be exhilarating. But there may come a time, for whatever reason, when they feel it's right to step aside, passing the baton on, or even selling up entirely. But when and why does this happen? What are the implications? And who should entrepreneurs be turning to for guidance? This episode explores these questions and more. I'm John Franklin.
And I'm Grace Treston.
And this is Wealth Insights from Julius Baer.
On today's episode of Wealth Insights, we're joined in studio by Glenn Branney, Julius Baer's UK Regional Head of Wealth Planning. Happy to have you here today.
Hi Grace, nice to be here.
Perfect. And Glenn, maybe we could start with just a quick explanation of what your role actually entails.
Sure. I work in our UK Wealth Planning team, which is one of our many wealth planning teams globally. In the UK, we provide regulated advice as a core part of Julius Baer's proposition across both our high net worth and ultra high net worth client segments. Areas of focus typically encompass succession planning, cash flow modelling, wealth structuring, retirement income planning, philanthropy, trust and estate planning, to name but a few.
Okay, and we obviously hear a lot these days about entrepreneurs and startup businesses, but if we were to go back to basics, what would you say is the life cycle that these people and their companies go through? So, for example, after a company has been founded and it's up and running, what's the next stage of development?
Yeah, there are probably two dimensions to that question, notwithstanding the fact, of course, that all entrepreneurs are unique and no one size fits all. There are probably two different life cycles. There's a business life cycle and then there's the personal life cycle. If we start with the business life cycle, that typically has 4 stages: startup, into scale and growth, into pre-exit, and then post-exit. And then, of course, the entrepreneur themselves will be on a 3-staged personal life cycle that covers 3 areas: accumulation of wealth, which is where the individual is amassing wealth, reducing debt over time; utilization of that wealth, which is typically marked by retirement. This can be, of course, retirement without retiring. And then preservation of wealth, which is this whole aspect of wealth stewardship, and I think has become even more prevalent over the past number of years, where people are now starting to consider how they pass on that wealth to the next generation, or perhaps to philanthropic ventures. The one thing that all entrepreneurs have in common is how busy they are. They tend to be very time poor, and as such, timely and targeted advice is particularly important to them. Many entrepreneurs tend to focus on their business and in their business, and so very rarely do they dedicate time to stop and focus on themselves and their families. And this is very evident for us here at Julius Baer via our partnership with EY, as we are the main sponsor of their Entrepreneur of the Year programme across the UK and Ireland. And this programme works incredibly well for both parties on so many levels, but at the centre is our joint collaboration and expertise in working with these entrepreneurs. I mean, entrepreneurialism has been at the heart of our own business at Julius Baer for over our 130-year existence, from our humble beginnings as a family-owned private bank to our standing today as the global reference in wealth management. And many of the entrepreneurs that we work with on the programme are family-owned businesses. We understand that family dynamic, and we also appreciate how crucial it is to partner with those founders at each stage of the entrepreneurial life cycle, not just pre and post-exit, but in the formative years where advice is so vital and where deep-rooted relationships are developed. And I guess you could say that is the very essence of sound relationship management.
And what point typically, in your experience, are entrepreneurial companies no longer considered a startup, and when can they be considered a more established business? Is this a significant shift within the company's life cycle?
I mean, the duration of an entrepreneur's journey will obviously vary from business to business, but It is fair to say that during startup, advice is most needed in respect to funding, attracting the right talent, and ensuring the most proficient personal and business advisory team are sitting around the same table as the entrepreneur. In my experience, startups take on average 3 to 5 years to become profitable, with quite a high percentage of those startups failing. So advice in the early days will be crucial. Each of those 4 stages I mentioned earlier of startup, scale, pre-exit and post-exit will generate their own unique challenges with advice required at each stage of that journey. So we find that advice from a wealth planning perspective tends to be more heavily focused on the last 2 stages of that business life cycle, namely pre-exit and post-exit.
Now, Glenn, once a company does become more established, it obviously becomes larger, a bigger operation that can be more cumbersome to operate and possibly can't work as entrepreneurially or as quickly as maybe their founders would like. What are the options when you get to this point and possibly a founder is saying it's time to do something different? Do they start again from the beginning, or do they give in to the big corporate lifestyle and maintain their role in the company?
It's a great question, John, and one we have helped our clients experience in the past. It is referred to, I guess, as the founder's dilemma, where the original entrepreneurs have been the architects of their company's success, but where exponential growth has resulted in a loss of control that is now beyond the founder's capability. I was recently introduced to a Harvard business study, the results of which came of little surprise. The study concluded that by the time ventures were 3 years old, 50% of founders were no longer the CEO. In year 4, only 40% were still in the corner office, and fewer than 25% led their company's individual public offering. Our clients, many of whom are entrepreneurs in the truest sense, struggle with delegation, with giving up control, and would cite the handing over the baton to the next generation as their number one business anxiety. The review goes on to say that founders eventually realize that their financial resources, ability to inspire people, and their passion are not enough to enable their venture to capitalize fully on the opportunities presented to them. They invite family members and friends, angel investors or venture capital firms to invest in their companies, and in doing so, they often pay a heavy price. On the other hand, founders who understand that they are motivated by control rather than wealth are more prone to making decisions that enable them to lead the business at the expense of increasing its value. The smartest entrepreneurs I've worked with realize early on where independent external expertise is required, whether that's operationally or at a board level. They recognize when the business needs more than just their vision and ambition. With the greatest succession, our experience are those where the initial ingredients are complemented by a skill set that is diverse and skilled enough to scale. Those founders who cannot accept a diluted role in that shift from startup to scale and growth often cash in their chips and either roll the dice again or sail off into the sunset to enjoy the fruits of their labor. In wealth planning, we are equally well equipped to offer the very best advice in both of those scenarios.
So say a founder's anxiety does take hold and they will relinquish control. Presumably it's not just a case of dump and run. Who will they need to seek advice from? And what are the main considerations they need to be aware of pre-exit?
Yeah, there probably are a number of considerations pre-exit, and I may repeat myself a little throughout this podcast, but these are very important components. The first one is surround yourself with a strong, competent team of professional advisors from both a business and a personal perspective. Ensure you're managing your key stakeholders and employees well. These are individuals who will ultimately ensure you maximize the value of your business. And on that, it's important to make sure your business is ready for sale. And I know that sounds like almost a leading point in itself, but it is very important that the business is ready to be sold. The deal itself, it's very important in my experience to be cognizant of the consideration behind the structure and the timing of the sale, who are you going to sell to, and how are you going to sell the business. And this next point is actually an interesting one, because it's all around the net sale proceeds and how are you going to maximize your position. Depending on your country of residence or domicile, there may be tax reliefs available, there may be issues and considerations that you need to be aware of before you sell. Some entrepreneurs will want to give to charities or to philanthropic ventures before they sell. So those are important considerations to throw into the mix. And how much of a security blanket, or what is the golden number that you and your family require to underpin your lifestyle needs to fund your essential and non-essential expenditure requirements? So it's trying to get the right amount of money into the right hands at the right time. And this whole question of how much is enough is an important one for an entrepreneur to consider before they sell their business. Future planning. Again, evaluating plans for the years ahead are important. Relocation can sometimes be a consideration for some entrepreneurs. The COVID pandemic has demonstrated that country borders still significantly impact the free movement of people and capital, even in regions like Europe, where borders were perceived to no longer exist. And it's probably best we don't go into the topic of Brexit today, but we are aware that relocation does have implications now that the world has moved on. And in markets where it is relevant, pension planning will be a key consideration. So any opportunity should be reviewed pre-sale.
What are the other things that an entrepreneur should be aware of? So, how involved should they be explaining their plans to family? Any legal obligations or limitations they need to keep in mind?
For many, the personal and the business are inextricably linked, and they cannot easily be separated. So it reinforces the importance of ensuring that both, for example, the personal will of the individual is written and up to date, and also the business will is written and up to date. And by business will, I'm referring to the articles of association, which should in there state what happens in the event of death, ill health, and retirement. In many articles that I've seen, that is not explicitly stated, and it should be, because it is very important to be considered. So it's very, in my opinion, it's very important that both sides of that same coin are covered. So there is the business, there is the personal entrepreneur, but it's important not to forget their families, which is the third element of this discussion. And I think a missing leg from that three-legged stool could prove disastrous down the line. Another consideration that entrepreneurs should be aware of is purpose. And in our German locations, by way of example, my colleagues tell me that their clients often tell them that they miss belonging to something bigger once they sell. These clients often look for new tasks, new challenges. In fact, for some, they require a completely new purpose. They sell on a Friday with the cash received for many on the same day. And then on the Monday they wake up and there's absolutely nothing to do except look at your bank balance. And for many, that is a very, very daunting task. So there's lots of hand-holding in the early days, and entrepreneurs are often so focused on making their business a success that any ideas not directly related to that goal are often not even considered or entertained. So wealth planners typically become confidants and provide that listening ear, which is so important, particularly in the lead up to a business sale.
Now, if we stay with the family element for a moment, we seem to be unable to get away from the looming great wealth transfer and passing on wealth to next generations. Do you find that successful entrepreneurs who might be sitting at home just staring at their bank balance use an event such as a business sale or an exit to transfer wealth to their children, to future generations? And what are the main options for them to do this?
I think that could be a podcast in itself, John, but the recent pandemic has focused many of our minds, and it is fair to say that succession planning and the transfer of wealth forms part of almost every conversation we have with family businesses. The desire for wealth transition, not just to the next generation, but for 2 or 3 generations to come, means that many family businesses may have to change their approach and look outside the family to increase that longevity rather than relying on the next generation to inherit it lock, stock and barrel. You'll have heard the adage, the first generation builds the business, the second holds on to it, and the third loses it or squanders it. And it may simply be that the skill set or appetite of the next generation to take on the business is just not there. Similarly, the values of the family business may not align with those second or third generations down the line. For example, the heightened importance of ESG principles in business has come to the fore. So environmental, social and governance, predominantly amongst the younger generation. And different viewpoints on this topic, I've seen it so many times, can make succession planning difficult to manage if younger generations become disenfranchised by current or past practices of the family business. It is therefore, in my opinion, increasingly important to consider in those situations moving from being a family business to becoming a business family. And communication and governance are critical elements when developing a business family framework. We've heard many times the topics of family charters and family councils, but they are increasingly being used to set the purpose, to maintain control, and to professionalize the management of broader family wealth. In more complex frameworks or more complex family situations, we're now seeing legal, tax, and wealth planning expertise working in partnership, almost creating a mini family office, if you like, around the business family. And for these family businesses, thinking long term can feel impossible at the time, but it does need to be encouraged even in the early years, and in particular during such turbulent times like we are experiencing now. But I guess, John, just to answer the last part of your question, are we seeing much evidence of that wealth being transferred? Yes, we are. And we are seeing, interesting, I can give you a quick example because it's fresh on my mind, entrepreneurs who are starting to divest some of that wealth to their children. And this particular client of mine decided that he would bite the bullet and give a specific sum of money to each of his 4 children, just to use it as a litmus test to see how they would be recipients, or would they be responsible recipients of said wealth. So some weeks later, they were sitting around the dinner table, and the entrepreneur had asked each of his 4 children what they'd done with the money that they had been given. And the first 3 responded as you would expect, textbook type responses around they'd invested it, they hadn't spent it, and he was delighted. And the 4th daughter, who according to him had gone rogue, had decided to purchase a number of designer NFT handbags. And not only was he disgusted that she had used some of the money, or most of the money I should say, for this purpose, but in his opinion, these things had no use. He was looking at a mobile phone which had a number of handbags on it, and yet she was going out that evening with the conventional handbag to put everything in that she had invested in the digital form. So I think there's a bit of education on both sides of the family table perhaps required, but it is the way that we're moving. Digitalization is becoming a big part of our lives, and I think that will form an even bigger part of conversations going forward.
Well, I know there's definitely in my camp some education to be done on digital handbags. But if we stick with the issue of differing intergenerational values for a minute, particularly around ESG, or also having an impact with wealth, is a sale a common juncture for people to consider how they are part of something bigger again through charitable or philanthropic endeavors that you mentioned? Are these good vehicles for people's wealth and for them to be involved in and to really feel valued again?
Yes, and I did say earlier, since COVID, we have noticed a real shift into 3 main areas. So families, health, and philanthropic giving. So people want to leave their mark on the world. As one client put it many years ago, they want to give with a warm hand as opposed to with a cold hand. And I think that element of seeing your wealth working more beneficially is becoming more prevalent. This question of what is it all for? What is the wealth actually for? Is a really important question. And philanthropic engagement can bring great joy to individuals and strengthen families through shared values and purpose. I guess with philanthropy on the rise globally, entrepreneurs are becoming increasingly interested in making their mark on the world. That could be charitable giving, it could be volunteering, it could be responsible investing. Whatever it is, it does take a delicate balance of heart and head to approach one's philanthropic endeavours strategically. Entrepreneurs who are interested in this space typically wish to maximise the impact for those they wish to help. They want to understand the various taxation and legal implications in their country of residence and domicile. And of course, they want to ensure they safeguard their own financial future for generations to come. It was Andrew Carnegie who said it was more difficult to give money away intelligently than to earn it in the first place. And of course, Winston Churchill, who said we make a living by what we get and we make a life by what we give. So a very well considered and thoughtful approach is therefore required. And we are so lucky to have our own resident team of philanthropic experts at Julius Baer who help our clients navigate this maze.
And Glenn, you touched on this a little earlier, but if we were to look at things from in terms of the human response after an exit, what does happen next, and how do people tend to deal, or how should they deal with such a sudden windfall and a huge change of pace in their life?
Yeah, a really interesting question, Grace. I guess no longer being in control can mean for many entrepreneurs that not only is the potential return not as great because they're not managing their business, but having a range of investment portfolios inadequately compensates when compared to having most or all of one's wealth in a trading business. However, the risk profile of entrepreneurs can change, and most entrepreneurs' risk profile does change post-sale. Many do not seek undue or unnecessary risk. These individuals tend to be much more focused on preserving the wealth they have taken the risks to create in the first place, unless they decide to go again, of course. But many do find a period of adjustment and reflection is needed. And in many cases, the advice that we give is to do nothing for a period of time so that this adjustment can be registered properly. We said earlier, dealing with cash on Monday that wasn't there on Friday is a very daunting and overwhelming task for many. So we try to help clients through 3 areas of focus. The first one is define a personal finance strategy. And that will start with putting the money that has been received into 3 boxes. So compartmentalizing the wealth that has been received can help. The first box is typically the survival box. That's the rainy day, the emergency fund box, where clients will put in there the amount of cash they feel they need for an emergency, for perhaps some opportunistic investments that will be personal to each entrepreneur. The second box is the main box, the sustainability box. And if you like, it is the engine room behind the client's core wealth planning strategy. And this box is characteristically well diversified across various growth-orientated asset classes alongside structures to maximize tax efficiency. And if I liken this part of the strategy to a jigsaw puzzle, the more pieces that are in that puzzle, the better, because diversification is going to be completely key here. And then the third box is succession, and that typically gets populated with more money from the second box as clients get older, as they start to think about the next generation, children, grandchildren. And if I may, I talk about this golden decade where clients that are 55 or 60, for the next 10 years, they tend to have the ability and the appetite and the propensity to travel and to enjoy the wealth. And those 10 to 15 years tend to be the years in which we see clients travel more and spend more. When they get into their 70s, not that I'm stereotyping any of our clients, but whenever they get into their 70s, they tend to get fed up traveling through airports and not wanting to deal with people, and become much more focused on their children, their grandchildren, And this is where the third box gets more populated from funds in the second box. There is a journey that those clients effectively go on, and they end up with more money in the third box, as I say. Wills and powers of attorney, very important to get those written and up to date, and keep up to date as clients go through that strategy. The second area of focus would be investing the sale proceeds tax efficiently. That's simply undergoing some cash flow modeling, making sure that the money is doing what it should be doing and it's in the right type of structures from a tax efficiency perspective. All of this needs to align with the family values. And then thirdly, planning the estate. Depending on the country in which you reside, there may be some form of death duty or inheritance tax or tax planning that needs to be considered. Indeed, we have our own team of trust specialists in Julius Baer who can help entrepreneurs in this regard. It is also important that any structure that is deployed is malleable enough to allow for any legislative or governmental changes. And of course, we mentioned education earlier to both the younger generation and perhaps to the older generation, because the education piece is going to be something that we'll all need to embrace as we move forward. And for some clients, life insurance may be relevant. Not for all, but for some, it may be something that we need to consider.
Well, indeed, we're all reminded every day that we never stop learning. But obviously, people are all individual. Every situation is different. But currently, are there common points of discussion between entrepreneurs that you're seeing? Perhaps it depends on whether they're in their golden decade or what sector they were operating in.
Yes, I think the main trend we see right across the globe at Julius Baer from a wealth planning perspective is the lack of planning or not planning early enough. Many leave the planning process until it is too late, and they end up missing many of the opportunities available to them. It's an interesting question because there are a number of common trends and traits across the various markets in which we operate. And for example, recently, in one of our Latin American locations, we had a number of family businesses with no formal protocol that aligned the main family interests and values. And these are emotional factors within family businesses that play a much more important role than just generating profits. Our team in this location believed it was more beneficial to help the families appoint an external professional or advisor who was able to help manage this process in an impartial manner, a mediator, if you like. I would suggest that the same could be said across all markets that we operate where this potential conflict exists. And I guess if I may just share one last point on this question, John, I read a book recently called The Geometry of Wealth, and the author tells us in that book that many individuals find that money is the most stressful factor in life, more stressful than death, politics or religion. And it's either the first or the second most important issue behind divorce. So although entrepreneurs deal with money issues regularly, if there is a liquidity event looming, then some form of assistance will most definitely be required to help navigate these issues.
And Glenn, as you know, this is the Wealth Insights podcast. So we always like to ask our guests to sort of summarize their wisdom for the listeners. So how would you sum up the most important wealth insights that entrepreneurs should take note of if they're preparing for a business exit?
I thought you were going to ask me that, Grace, having listened to the last podcast. So I have prepared something in true Blue Peter style. So there are four elements to this question I'll leave you with. The first one is surround yourselves with a team of professional subject matter experts. It's never too early to be prepared. The earlier, the better. Secondly, there are always bear traps. So being able to think well in advance and plan accordingly will serve you well in the long run. Position your business as effectively as possible for the exit, as in my experience, a well-crafted exit strategy will both optimize trading profit and also increase the eventual selling price. Thirdly, what is your ultimate purpose? What is the wealth for? What do you want your legacy to be? Do you have a will? Is it written? Is it up to date? And is it accurate? Do you have lasting powers of attorney? Are they up to date and are they accurate? Remember, an inability to make decisions freezes the wealth creation of an entrepreneur and that needs to be avoided at all costs. I guess minimizing risk before maximizing return is the key message there. And if there's one thing that our listeners will take away today, it will be to write a will and to write a lasting power of attorney. And how much do they want to allocate to loved ones or charitable causes? When do they want to do that? And how do they want to do that? And fourthly and finally, I've said it before and I'll say it again, plan early, be prepared, and surround yourself with the right trusted team of professional advisors. Ensure that all three legs of the same stool are being considered, namely your business, your family, and of course, most importantly, yourself. And I will leave you with a quote that I picked up from another book that I think is a really useful one to read for entrepreneurs. It's called Rich Dad, Poor Dad, written by a guy called Richard Kiyosaki. And he says, it's not what you make, it's what you keep, how hard it works for you, and how many generations you keep it for.
Some very sound words indeed. Well, that's all we have time for in today's episode. Thank you to Glenn for joining us, and thank you to you at home for listening. We will be back again soon with another episode of Wealth Insights, but don't forget to subscribe to us on Apple Podcasts, Spotify, or wherever you like to listen.